I'm going to introduce our panelists. We have Andrew Siwo. He's the Director of Sustainable Investments and Climate Solutions for the New York State Common Retirement Fund, one of the biggest pension funds in the country. Will Atcheson is ESG Strategy with Jefferies, investment banker, and Rich Mattison with S&P Sustainable One, part of the S&P Global Network. So I want to just dive right into the questions. And I'm going to start with the question of semantics and lexicon and words, the words we use to describe these things. For Andy, when we were talking in the prep for this, I used the term ratings. And you kind of took, you're not a big fan of that as far as the ESG world goes. ESG scores and this is the name of this session. So I'm just curious, you're not a big fan of that word when we describe this sort of space of metrics. Why is that?
Okay, am I on mute?
I don't know. No, you're not.
Okay.
We can hear you.
Yeah, so I think it's more than just semantics. If we think about some of the incendiary comments that we've been hearing recently about ESG, and partly from some moderate people that are widely liked, I think it's partly because the commercial case for ESG has outpaced the investment case. And as a result, this term ESG has become increasingly bombastic. So from a fiduciary standpoint, what is decision useful is what we tend to want to focus on. When I think about the credit rating business, everyone knows what a BBB- bond is. There are 4 rating agencies with a 0.99 correlation that will come up with the exact same conclusion with similar data. However, an ESG score of 76, do we all know what that means? Can we trade off of that? Voluntary, self-reported, unaudited information? Is that decision useful? And so I think that clarifying credit rating and ESG score is quite important.
Mm-hmm. So Will, is it the ESG, what's really important about the scores? Is it the scores themselves or the data underlying them?
Yeah, that's a fantastic question. Look, so we kind of agree with Andy here at Jefferies. We don't see much value in a rating or a score. There's not a lot of transparency there. There's not a lot of consistency. But, you know, they have done something right. So these rating agencies, these scorers have gone out and actually created the databases and identified KPIs that they think are material. And for us at for us at Jefferies, for us in ESG, ESG investing should be good fundamental analysis, right? It should be leveraging a materiality map to identify intangibles and externalities that account for about 90% of market cap value, and using this lens to then identify better risks and opportunities associated with it, right? Not all of these issues are going to be key to every equity. So that's really where the scores and the ratings have contributed to the ESG conversation today. It's not complete. We've actually run MSCI versus SASB linkages. It's about 92% on average overlap, but only 50% of those are actually filled in. They actually have data points. So there's still a lot there. It's not 100% there, but it's a good starting point, and they have done a good job of aggregating and starting the data that we're going to need to do good ESG investing and analysis.
Mm-hmm. So Richard, why do we need these independent scores? Why, let's hear the case for them.
Yeah, I mean, let me start by saying I completely agree that it's critical that we have the right ESG intelligence. In fact, it's more critical now than ever before. We're facing a lot of disruption in the world. We need to understand trade-offs and balance those trade-offs as we pursue various different types of capital allocation. So having the right intelligence at your fingertips is totally critical. But I would argue that, first of all, we need better transparency. We need better clarity about definitions, and we need more disclosure to make the whole system better. And that is going to happen. You have the ISSB, you've got, the SEC, depending on how successful the proposed climate rule ends up being in terms of being implemented. And you have a number of other efforts across the world on enhancing reporting and disclosure, which I think is absolutely critical. And that will then enhance the intelligence that we're providing. But I do think that having independence and objectivity of opinion is critical. So in the same way you reference credit ratings, why do we have credit ratings when every bank actually has their own way of credit scoring? So every bank can use the intelligence that credit ratings have and come up with their own opinion, have their own credit scores. The reason why you have credit ratings is not just because they're a useful, well-understood indicator, it's because they're an independent, useful, well-understood indicator. So I think we need some independence in the system to ensure that we have robust decision-making. Of course, every asset manager and bank should have their own way of deciding what is important from an ESG point of view, and the underlying intelligence is critical. But I also think that the independence and objectivity that you see in the credit rating space is also critical in this space. Otherwise, we're going to face more challenges going forward.
I saw the brain cells moving around quite rapidly here. So these are two very big organizations we're talking about here. So what about, smaller? Is that the smaller investors that really need those independent scores? They're obviously doing a lot of their own research.
Yeah, the market is, frankly, even over the last 6 months, the levels of education on ESG have gone through the roof,
right,
as we have seen controversy. So in a sense, ESG ratings have actually done their job. They've highlighted certain issues that are up for debate, certain areas that need more transparency. I think that's totally actually right. But not every organization is as well equipped as you guys are to handle the underlying intelligence and to be able to assess and assimilate that information. I can tell you that there are many of our clients who are just not quite there yet with resources or sophistication to be able to interpret, what is potentially 1,000 different data points on 11,000 companies that we analyze. That's a lot. We have 700 billion data points on climate risk. That's a lot. So at some point, the data needs to be converted into intelligence. And one form of intelligence is a score. It's only one form, I would agree, but it is one important form.
Right, so speaking of which, Andy, you have a very specific philosophy by which your team looks at these things. So can you tell us a little bit more about that approach? And, if scores are, what is it that you use to figure out where you're going to put your focus?
Sure. I think it involves the interpretation of the data. So I would argue that some of the transparency is already there. However, I'm not quite sure if you can compare a consumer packaged products company to an insurtech company under the auspice of environmental, social, and governance factors. One of these days, this will just be called investing. I think Benjamin Graham is probably rolling in his grave right now if he woke up to find out that a proxy for risks and opportunities is an actual thing. So what I do believe is quite important is when we start to make ordinal references, we have to audit them and question them. So never does the second place person get the gold medal. We're able to audit what is first, second, and third. So when we start to make these ordinal references like good at ESG, what exactly does that mean? So if you've made a private equity investment 10 years ago and you have good, fair, and poor, does the IRR and the DPI 10 years later, ex post data that we're looking at, what if you found out that the C student actually scored higher than the A student? Universally, we know that can't happen. Whether you're in Paris, Moscow, Nairobi, these are ordinal references that we understand and are universal, and they're powerful as a result of that. And if we are continuing to assign these ordinal references, if they do not have that empirical support, I think that ESG will continue to face challenges. Now, I think the bright areas include areas such as process and methodology. So if someone has a good process or a good methodology in terms of investment selection, whether that manager performs or does not perform, we're not talking about their performance, we're just talking about the process and methodology. Just like if you have a good process for, I hate these sports references, but shooting a free throw, it doesn't necessarily mean it's going to go in. But the process and methodology are items that are void of these ordinal references that we loosely use, but may not be grounded in empirical support.
Right. Jefferies has a lot of research. I get a lot of the research. So what are the metrics that are really most important for your opinions on this right now, and why?
No, Wendy, Heather, that's a fantastic question, but I just want to build off something Andy said real quick, right? And that's this idea of materiality and dynamic materiality, right? So this idea that what matters today might not matter tomorrow or might not have mattered in the past, but also I don't have time to look at 7 billion climate data points, right? Especially if it's not actually important to the investment thesis or the driver of the company, which is why we're a real big fan, again, of a materiality map approach, identifying the few material things that will actually drive a company's performance. I'm sorry, I'm going to go back to your question.
So what is really driving the opinions that you're putting out on this? What are the metrics you're looking at most closely right now?
Yeah, so look, that's a fantastic question, and it's one that I've been trying to figure out in my conversations with clients and corporates. Right, we have this climate proposal coming out, right? So this SEC wants to put out climate disclosures. Everyone's asking me, what do I do if I get a GHG intensity number? And it's a great question, right? There's relative positioning, sure, there's potential risk associated with it. But let's be real, there's no carbon price coming in the United States market. And against the backdrop of today's energy crisis, it's very hard to think that you're going to see incremental moves on carbon prices in the next year or so. So what do you do with it? It's an interesting question. So what data points do we really like? Well, today we're incrementally focused on human capital. And why? Because it's something that no one's really focusing on yet, or they've just started to, so it's easier for us. We're a little bit lazy. But also because I think, right, every CEO gets on a phone call with you and tells you their most valuable asset is their employees. What do I do with that? How do I measure it? So we really look at 3 metrics. It's an internal net promoter score, it's employee engagement, and it's employee turnover. So those are the 3 metrics. Now, some of these rating agencies have some of this data, but it's not ubiquitous, it's not homogeneous, and it's not pervasive. So look, that's really where that's the data we're focused on today, on the human capital aspect, and we're still trying to figure out the environmental aspect.
Mm-hmm. Rich, you mentioned before, and you and Dave both alluded to the diversity, the lack of correlation that we're seeing right now. Does there need to be more correlation? And if not, why should you value diversity of scores?
Yeah, I mean, I think if ESG scores or a component of an ESG score is measuring something that should be universally agreed as a distinct point, and that actually there is a track record that you can measure against, like credit ratings. The reason why credit ratings are well correlated is because they're a track record of default. So every rating agency modifies continually its methodology to ensure it gets better and better at predicting credit risk. Mm-hmm. So they are essentially harmonizing around a history of default and getting better at predicting that over time. What is that equivalent in ESG? I mean, it's a huge space. There's so many different things to look at. That's part of the reason why you don't have correlation. But the other reason is, and this is, a hypothesis, but maybe ESG ratings or scores shouldn't really be compared to credit ratings. Maybe they're more akin to something like earnings estimates, where we do value the diversity of opinion. Frankly, it is interesting that you might have a different opinion about the earnings of a company versus another analyst. And in that difference is some interesting narrative and dialogue when you dig into it. And why? Because it's a very complicated set of things that you're analyzing when you're analyzing a set of earnings. And you're analyzing all aspects of the prospects of a business. And you can use many different types of data. Some analysts use different models and different data sets. And actually, that's totally accepted by markets, that diversity of opinion. So my question really is, should we be aiming for a more precise but singular defined measure of ESG that you can look and correlate more tightly, but it's really narrowly defined around a very few set of criteria and it's measurable over a track record and time? Or should we actually be thinking more about valuing that diversity of opinion and understanding why there is a difference in opinion? Because that actually might drive some insight through the marketplace. That's an open question.
Yeah, I'd just like to add, this, what we've done that has helped is look at this as in an asset class specific way. So for example, on the IOU side, on the credit side is really, can you pay me back? And if not, what can I recover? So I can ask my 60-year-old nephew, which friend would you lend money to? He'll say, Johnny next door. If he doesn't pay me, I'll just walk over and beat him up. Like you could be a bond. Wow, that's credit, good credit underwriting. So But there are endless reasons on the equity side why stock prices go up and down. But on the bond side, or on the credit side, in fairness to credit ratings, you're only looking at two things, right? So on the equity side, for everyone buying a stock, someone with the exact same information is selling that same stock. So I'm not quite sure if we should be looking for standardization, but comparability is important. So anyone covering a large cap stock, 15 analysts, 5 will say buy, 5 will say hold, 5 will say sell. I expect that. Now, if everyone said buy on an equity, I'd be a little nervous. So I think the standardization is something that I'm not quite sure we should be aiming for, but comparability. So I talked to, if not S&P, maybe one of your peers, where they look at ESG scores, they're looking at sustainability. And I asked, well, what do you mean by sustainability? They said, well, a ESG score of 70 for, let's just say, an oil and gas company, that is the highest that they can actually get. And what this score implies is their preparation for the low carbon environment. And we need to compare oil companies to other oil companies. So when a electric car manufacturer CEO asked, well, why is it that my firm fell out of this S&P 500 ESG index, and then there's an oil company that's in there? Well, what is an oil company? One's a car company. You have to compare car companies to car companies and oil companies to oil companies, or this won't really make sense.
Mm-hmm. And I just want to build off that and touch on something you said, right? You talked about, EPS. I can take an EPS number and do a P&E and get a price target. It's very hard for me to take a 74 or a 76 and then be, I should discount my premia a little bit, right? Or maybe I should discount the multiple, or out year growth, I should be worried about that, or margins. I can't really tie that. Whereas with EPS, I can get a price target. Now, is it right? I think the market would tell you no, but you can get one. So I think that's kind of a little bit of difference there. And I value your insight. And look, you can highlight different things which different people are focused on, but I'm not sure if ratings is the best way to convey that information. Rather, it's conversations with management, it's thematic inclusion, and these different indexes, et cetera, that can really get you most of the same data without giving you a one number, right? A 74, what do I do with that? I don't know.
For anyone, how would you like to see credit ratings incorporate ESG score information? Should they be merged?
Well, our team has actually contacted and spoken with all 4 credit rating agencies for the same exercise to learn. And a lot of times when you're looking at pitch books, you'll hear everyone wants to talk about everything but performance, but ESG. and so we want to explore that a little bit. We have one credit rating agency that said this is complete nonsense. We focus on credit ratings. This is a little dangerous. Then we have a lot of others that say, well, this is how this is integrated in the investment selection process. Now, the question is, as you're pricing, let's just stick on the equity side, is the beta being, if these environmental, social, and governance factors, is this priced in? How much of it is priced in? Are you holding an overpriced stock, or are you holding an underpriced stock? So I think that to the extent that we can isolate the performance drivers, I believe that there's usefulness in it. Finally, I'd say that we made the decision years ago that every manager seeking capital from us has to opine on how they look at environmental, social, and governance factors. I think it is intuitive that more information likely puts you at a default advantage. I don't think many people would say that's too much information puts me at a disadvantage. And so we're still bullish on these factors. However, I don't think many people believe that this is an inherent source of alpha.
Got it. Well, quickly running out of time here, so I have one final question for all of you. What's the future of ESG scores, 1 year from now and 5 years from now? What role do we see them playing? And I'm actually going to zing you first, Will.
Great.
To get you talking. And I'm also, we're talking primarily US here, but other regions.
Yeah, look, I think there's a few valuable insights in ESG scores, right? One, there's a bunch of index that trades off it, so you can use that as you will. 2, again, there's data, and they do highlight issues, right? There are rating or scorers who do break down scores by ESG. In fact, almost all of them do. So it might give you an insight. But again, where we're leaning in, where we think the most value of it is this SASB MSCI linkages. So if I could ask raters or scorers to do one thing, build more data sets, and then start running correlations with them against line items in individual companies. I want to know if a company has a C rating, should I be worried about margin a year out? This is the kind of things I'm interested in as an investor. So that's what I'd like to see. And really, you know, in 1 year, probably still using it to highlight issues, probably still using it to direct funds. In 5, 10 years, hopefully we've gotten a little bit farther. Hopefully we've actually tied this to asset pricing.
Rich, you're up.
Yeah, I mean, I would highlight kind of the 3 areas, actually. Forgive me, but, you know, I'm kind of steeped in this and I'm a bit of a data geek. But I do think that the point about like financial relevance is critical. So I think that actually making sure that this information is financially relevant, it can be used by financial analysts such as yourself or asset managers and pension funds, that's critical. So for example, we do describe the losses, the anticipated losses associated with the physical impacts of climate change for the assets that we analyze, which we're expanding to about 80 million assets owned by, you know, tens of thousands of companies for that very reason. So that's coming soon. I also think though, you can get too focused on just risk and financial risk and miss the bigger picture, which is why the hell are we doing all of this in the first place? We're doing this to balance a consideration of financial risk and make money, but also create some kind of impact in the world. Because if it's just a financial risk measure, you can't call your fund an ESG fund. You can't call your analysis an ESG analysis, I would argue. So a clear articulation of both risk and impact is the second thing.
Perfect.
And I'll park the third thing because I'm out
Okay,
of time.
yeah, I want to give Andy a moment here to wrap us up.
Oh, well, no, I actually would yield to listen to the third point.
Okay, go then.
Oh, yeah. I do think that this type of information should be more predictive of future disruption as well as future earnings. Because disruption is not just about the earnings of one company, it's about disruption in the world that we're seeing. So, you know, where will we see geopolitical shifts associated with water scarcity and the like? I think that's actually critical for boards, it's critical for investors, macro analysis, all sorts of things. So I think that's another area.
Perfect, thank you. Andy, you good? You're going to let it stand? All right, well, please thank our panelists, Rich, Will, and Andy.